There is a mechanism that has controlled the price of silver for decades, and it is breaking. Not slowly, not theoretically, right now, in real time. The system that has allowed a handful of institutions to dictate what silver is worth by trading pieces of paper that represent silver that may not even exist is encountering a force it was never designed to withstand. That force is physical demand so large and so relentless that the paper market can no longer absorb it. And the fascinating thing is that most people who invest in silver have no idea how this mechanism works. They do not understand why silver's price can drop 3% in 5 minutes on a Tuesday morning when nothing has changed in the physical world. They do not understand why the price on their screen bears almost no resemblance to the price they actually pay when they walk into a dealer and try to buy a silver bar. They do not understand why a metal that is in a structural supply deficit for the fourth consecutive year somehow trades at a price that implies abundance. Today I am going to explain exactly how this mechanism works, not in vague terms, not in conspiracy language, in specific mechanical detail. I am going to show you how paper silver is created, how it is used to influence price, why the system worked for so long, and exactly why it is now failing. And then I am going to tell you how to position yourself so that when the paper market finally breaks and the physical price becomes the only price that matters, you are on the right side of what I believe will be the most significant repricing event in commodity markets in our lifetime. Let me start with the basic architecture of silver price discovery, because until you understand how the price on your screen is generated, you cannot understand how it is manipulated. The price most people see when they look up silver is the COMEX spot price. COMEX is a division of the CME Group, which operates the largest commodity futures exchange in the world. On COMEX, participants trade silver futures contracts. Each contract represents 5,000 ounces of silver. When you buy a silver futures contract, you are entering an agreement to purchase 5,000 ounces of silver at a specific price on a specific future date. When you sell a silver futures contract, you are entering an agreement to deliver 5,000 ounces of silver at that price on that date. In theory, this system exists for two purposes. First, to allow silver producers and industrial users to hedge their price risk. A mine can lock in a selling price for future production. A solar panel manufacturer can lock in a purchase price for future needs. Second, to provide transparent price discovery by aggregating the buying and selling interest of all market participants into a single visible price. In theory, this is an elegant system. In practice, it has a fatal flaw. You can sell a futures contract without owning any silver. You can sell 1,000 futures contracts representing 5 million ounces of silver while owning 0 ounces. As long as you close that position before the delivery date or roll it into the next contract month, you never need to produce a single ounce of physical metal. This means the price of silver can be influenced by entities that have no silver, have never had silver, and have no intention of ever handling silver. They are trading a price, not a commodity, and the volume of this paper trading dwarfs the physical market by orders of magnitude. Let me give you the numbers, because the scale of the disconnect is almost difficult to comprehend. On a typical active trading day, COMEX silver futures and options volume represents the equivalent of 300 to 500 million ounces of silver changing hands. Some days it exceeds 700 million ounces. Annual global silver mine production is approximately 830 million ounces. That means the paper market trades the equivalent of an entire year of global mine production in roughly 2 trading days. In a single week, the paper market trades more silver than every mine on Earth produces in an entire year. The physical market, where actual bars of silver move from seller to buyer, operates at a tiny fraction of this volume. The paper market is not reflecting the physical market. The paper market is overwhelming the physical market. It is like trying to determine the fair price of a house by letting 1,000 people who have never seen the house and have no intention of buying it place bets on what they think it should be worth, while only 2 or 3 actual buyers and sellers conduct real transactions. The bettors set the price, not the buyers and sellers. That is how silver pricing works. And it has worked this way for decades. The specific mechanism by which this paper trading suppresses price is not complicated once you understand the players. The dominant sellers on COMEX are a small number of large commercial banks. According to the CFTC's Bank Participation Report, 4 or fewer banks typically hold a net short position in silver futures that represents a staggering share of total open interest. As of the most recent report, these banks were collectively short a volume equivalent to more than 160 days of global mine production. These are not hedgers. A legitimate hedge offsets a physical position. If a bank held 160 days of mine production worth of physical silver in its vaults, a short of that size would be a hedge. These banks do not hold anything close to that amount of physical silver. They are net short, meaning they owe more silver than they own. This concentrated short position gives them enormous influence over price because they can sell massive quantities of paper silver into the market at times of their choosing. The most effective time to sell is during periods of low liquidity when fewer buyers are present to absorb the selling pressure. This is why you often see sharp silver price drops during the early morning hours in New York when Asian markets have closed and European trading is thin. A large sell order hitting a thin market creates a disproportionate price impact. The price drops, stop losses trigger, other traders see the drop and sell in panic. The bank that initiated the selling can then buy back at lower prices and pocket the difference. This is not conjecture. This pattern has been documented extensively through academic research, CFTC enforcement actions, and multiple bank settlements where financial institutions paid hundreds of millions of dollars in fines for manipulating precious metals markets. JP Morgan alone paid over $900 million in 2020 to settle charges related to precious metals spoofing, which is a specific form of the manipulation I just described. They paid $900 million, not because they were innocent, because the evidence was so overwhelming that fighting it in court would have been worse. Now let me explain why this system is breaking, because this is where the analysis gets genuinely exciting for anyone who holds physical silver or is considering acquiring it. The paper manipulation mechanism works only as long as two conditions are met. First, there must be enough physical silver theoretically available to maintain the illusion that paper contracts could be settled in metal if anyone actually demanded delivery. Second, the majority of market participants must be willing to settle in cash rather than demanding physical metal. For decades, both conditions were comfortably met. COMEX warehouses held tens of millions of ounces of registered silver. Industrial demand was stable and predictable. Investment demand was modest. Nobody seriously tested the delivery mechanism because there was no reason to. The paper price was close enough to the physical price that the system functioned without visible stress. Both conditions are now failing simultaneously. COMEX registered silver has plummeted to 2.18 million ounces. That is the deliverable supply. 2.18 million ounces backing a paper market that trades hundreds of millions of ounces daily. The ratio of paper claims to deliverable silver is now so extreme that it defies any reasonable definition of a functioning market. When I say this number to people outside the precious metals space, they literally do not believe me. They think I am exaggerating. I am not. Go to the CME Group website, look up the COMEX Silver Warehouse Stocks Report. The number is right there. It is public. It is updated daily. And it is terrifying if you understand what it implies. The second condition is failing because physical demand has exploded beyond the system's ability to absorb it. Solar panel manufacturing consumed over 200 million ounces of silver last year, and that number is growing at 27% annually. Electric vehicle production is intensifying silver usage per vehicle. Artificial intelligence infrastructure requires silver for thermal management in data centers. Military applications from advanced weapons systems to satellite components consume silver in growing quantities, and investment demand from both retail stackers and sovereign buyers has surged as confidence in the paper pricing system erodes. Total global demand now exceeds total global supply by approximately 150 million ounces per year, according to the Silver Institute's own data. The market has been in deficit for 4 consecutive years. Each year of deficit draws down existing above-ground stockpiles. Those stockpiles are finite, they do not regenerate, and they are running out. The Shanghai premium is the clearest evidence that the paper mechanism is failing. Physical silver on the Shanghai Gold Exchange currently trades at a 60.3% premium to the COMEX paper price. In a functioning market, that premium would be 2 to 5%, reflecting transportation and transaction costs. At 60%, the Shanghai market is telling you that the COMEX price is a fiction. Chinese manufacturers who need silver to build solar panels and electronics do not care about the COMEX price. They care about acquiring physical metal, and they are willing to pay 60% above what New York says silver is worth because New York's price is generated by paper trading that has no relationship to physical availability. Shanghai's price is generated by actual transactions where real metal changes hands between real sellers and real buyers who need it for real industrial applications. One of these prices is real, the other is a derivative of a trading game, and the gap between them has never been wider. Let me describe exactly what it looks like when the paper mechanism finally breaks, because understanding the mechanics of the break is essential for positioning correctly. The break happens when enough market participants simultaneously demand physical delivery rather than accepting cash settlement. This can be triggered by several events. An industrial user who cannot source silver through normal channels turns to COMEX as a last resort and stands for delivery. A fund or sovereign wealth entity decides to convert paper claims into physical metal as a strategic reserve decision. A cascade of delivery demands hits during a single contract month, overwhelming the registered inventory. Or most likely a combination of all three happening simultaneously during a period of already extreme physical tightness. When delivery demands exceed available registered inventory, the exchange faces a choice. It can allow delivery failure, which would be an existential crisis for the exchange's credibility. It can raise margin requirements dramatically to force paper longs to liquidate their positions before delivery, which is a form of manipulation in itself. It can change the rules to allow cash settlement at a premium to the paper price, which acknowledges the disconnect but does not resolve it. Or it can allow the price to rise to whatever level is necessary to attract physical supply back into the registered category. Historically, COMEX has used margin increases as its primary tool for managing delivery pressure. In the 2011 rally, COMEX raised silver margin requirements 5 times in 9 days. Each increase forced leveraged longs to deposit more cash or liquidate positions. The selling pressure from forced liquidation crashed the price. This was not a natural market correction. It was an engineered outcome designed to protect the short side of the market from a delivery crisis. The question for today is whether that tool still works in current conditions. I believe it does not. Here is why. In 2011, the physical market was not in structural deficit. There was ample above-ground supply. The rally was driven primarily by speculative paper buying, not industrial demand. When margins were raised, the speculative longs sold because they did not actually need the metal. They were trading for profit. They took their profits or their losses and walked away. The physical market barely noticed because physical demand had not fundamentally changed. Today, the demand driving silver higher is industrial. Solar manufacturers need silver. AI infrastructure builders need silver. EV producers need silver. When you raise margin requirements on a solar panel company that is trying to source silver through COMEX because they cannot find it anywhere else, they do not sell their futures position and walk away. They still need the silver. Their factory does not stop running because the CME raised margins. They either pay the higher margin and stand for delivery, or they go to the physical market and pay whatever premium is necessary. Either way, the demand does not disappear. It is structural. It is inelastic. Margin increases in 2011 worked because the demand was speculative and elastic. Margin increases in the current environment will fail because the demand is industrial and inelastic. The tool that saved the paper mechanism last time will not save it this time. And when the market realizes that the tool no longer works, the repricing will be violent. Let me describe what the repricing looks like in practical terms. When the paper mechanism breaks, the COMEX price does not just rise, it initially becomes irrelevant. Physical transactions begin occurring at prices completely detached from the COMEX quote. Dealers stop pricing off spot and start pricing off replacement cost. Industrial buyers negotiate directly with miners and refiners at prices that reflect actual scarcity. The Shanghai price, which is already at a 60% premium, becomes the de facto global price because it reflects physical reality. COMEX either adapts by allowing its price to surge to match physical, or it becomes a sideshow where paper traders exchange contracts that nobody intends to deliver against while the real market happens elsewhere. Eventually, the prices converge because a market where the same commodity has two wildly different prices is unsustainable. And they converge by the paper price rising to meet the physical price, not the other way around. Physical prices do not fall to meet paper because physical prices are set by the irreducible cost of acquiring actual metal. Paper prices rise to meet physical because paper prices are set by trading activity that can move in any direction once the mechanism that anchored it to artificial levels breaks. Now let me tell you how to position for this event, because understanding the mechanics is only useful if you translate that understanding into action. The first and most important positioning decision is to own physical silver, not paper silver, not ETF shares that depend on a custodial chain, an authorized participant mechanism that may buckle under exactly the conditions I have described. Physical silver. Coins or bars in your personal possession, or an allocated segregated storage where specific serial numbered bars are identified as yours and no one else can claim them. Physical silver has no counterparty risk. It does not depend on COMEX remaining functional. It does not depend on a bank honoring a contract. It does not depend on an authorized participant choosing to arbitrage. It sits where you put it, and its value is determined by what the physical market says it is worth. In a world where paper and physical prices are converging upward, physical silver is the purest expression of the thesis. The second positioning decision involves silver miners. When the paper price breaks free and converges with the physical price, mining companies experience a dramatic expansion in profit margins. A mine that was profitable at $50 silver becomes extraordinarily profitable at $150 silver. Their costs do not rise proportionally because most mining costs are fixed or semi-fixed. The leverage that mining shares offer to the silver price is substantial. A 50% increase in silver's price can translate to a 200 or 300% increase in a miner's earnings and potentially a similar move in the stock price. However, miners carry risks that physical metal does not: management risk, jurisdictional risk, operational risk, dilution risk. They are leveraged bets on silver's price, and leverage works in both directions. If I am wrong about the thesis, and silver falls, miners will underperform physical by the same multiple they would outperform if I am right. Size miner positions according to your risk tolerance and understand that they are a higher risk, higher reward complement to a physical position, not a substitute for it. The third positioning decision is to reduce or eliminate exposure to paper silver products that carry the structural risks I described in my previous video on ETF fine print. If you hold silver ETFs, read the prospectus. Understand the custodial chain. Understand the authorized participant mechanism. Understand the cash settlement clauses. If you are comfortable with those risks given current market conditions, that is your decision to make. If you are not comfortable, and given what I see in the data, I would not be comfortable, then consider converting paper exposure to physical exposure while the conversion is still possible at reasonable premiums. There may come a time when the premium to convert from paper to physical becomes so large that the conversion is no longer economically rational. That time is approaching. It may not be here yet, but the direction is clear and the pace is accelerating. If you are struggling to understand where to start or feeling confused about silver and online earning, you are not alone. I hear from people every week who tell me they want to take action but do not know the first step. They are overwhelmed by conflicting information. They do not know which products to buy or where to buy them or how to verify what they are getting. I have created a complete step-by-step guide on my website to make things simple. There are free resources to help you get started, covering the basics of physical silver acquisition, storage considerations, and how to evaluate dealers. And there is a detailed 50-page premium guide for those who want to go deeper and get real results, covering advanced positioning strategies, portfolio allocation frameworks, miner evaluation criteria, and the specific metrics I track to time my own decisions. If you found this video helpful, you can support my work by checking it out at ogjonag.com. Everything I publish on this channel is free and will remain free. The website resources exist for people who want a structured, comprehensive reference they can work through at their own pace, rather than trying to piece together a strategy from individual videos. The fourth positioning decision is timing, and this is where most people get it wrong. The paper mechanism will not break on a specific date that I can predict. It will break when the accumulated pressure exceeds the system's capacity to contain it. That could be next month, it could be 6 months from now, it could be triggered by a specific event like a major delivery failure or a bank insolvency, or it could be the result of gradual persistent drain that eventually crosses a threshold. Because the timing is uncertain, the correct approach is not to try to time the break perfectly. The correct approach is to establish your position before the break and hold it through whatever volatility occurs between now and the resolution. Trying to time the exact moment of the break is like trying to predict which specific snowflake causes an avalanche. You cannot do it. What you can do is recognize that you are standing on an unstable slope with accumulating snow and move to solid ground before the slide begins. Let me tell you what I am watching as leading indicators that the break is approaching. The COMEX registered inventory trend is the most important single metric. As long as registered continues declining, the pressure is building. A reversal in this trend, meaning a sustained rebuilding above 4 or 5 million ounces, would signal that the mechanism has found a new equilibrium and the break may be delayed. Right now, the trend is unambiguously lower and the rate of decline is accelerating. The Shanghai premium direction and magnitude tells me whether the physical market is pulling further away from or converging toward the paper market. Above 50%, the disconnect is extreme and growing. Between 30 and 50%, it is significant but potentially stable. Below 30%, it is normalizing and the urgency diminishes. Currently at 60.3%, the physical market is telling me the disconnect is extreme and growing. That favors an approaching break, not a delayed one. The behavior of the concentrated short position tells me whether the entities most invested in maintaining the current system are weakening, when shorts begin covering open interest declines while price rises. That tells me the pressure has exceeded their ability or willingness to fight. We have not seen covering yet. Open interest has been rising alongside price, which means the shorts are doubling down. When covering begins, it will be visible in the commitment of traders' data, and it will mark the beginning of the end of the current mechanism. Changes in exchange rules are an important but underappreciated indicator. When COMEX raises margins, announces position limit changes, modifies delivery procedures, or issues unusual advisory notices, it tells me the exchange itself recognizes that stress is building. These rule changes are the exchange's version of sandbags before a flood. They tell you the flood is expected even if you cannot see the water yet. Let me address the most common objection I hear when I discuss paper manipulation breaking. People say they have been hearing about COMEX breaking for 20 years and it has not happened yet, so why should they believe it will happen now? This is a fair objection, and it deserves a serious answer. The people who predicted a COMEX break in 2005 or 2012 or 2018 were identifying a real structural vulnerability. They were correct about the vulnerability. They were wrong about the timing because the conditions for a break had not fully matured. In 2012, COMEX registered silver was above 30 million ounces. The Shanghai premium was negligible. The structural deficit did not exist. Industrial demand from solar was a fraction of current levels. AI data centers did not exist. The conditions that would trigger a break simply were not present. Predicting a dam break when the reservoir is half full is premature. Predicting a dam break when the reservoir is overflowing and cracks are visible in the structure is pattern recognition. We are in the overflowing and cracking phase now. COMEX registered at 2.18 million ounces is not half full. It is nearly empty. Shanghai premiums at 60% are not a minor discrepancy. They are a screaming alarm. 4 consecutive years of structural deficit is not a blip. It is a trend that is depleting finite above-ground stockpiles with no mechanism for reversal in the near term. The people who cried wolf for 20 years were wrong about timing, but right about the wolf. The wolf is now visible, and it is closer than it has ever been. The final point I want to make is about what the world looks like on the other side of the break. When paper silver manipulation ends and the price of silver is determined by physical supply and physical demand, rather than by paper trading volume, the price will be dramatically higher than it is today. How much higher depends on how quickly the adjustment happens. A gradual adjustment over 12 to 18 months might see silver settle in the $150 to $200 range as the price finds a level where physical supply and demand balance at new equilibrium quantities. A sudden break triggered by a delivery failure or a cascading short squeeze could see prices spike temporarily much higher before settling back. Either way, the direction is up and the magnitude is substantial because the current price does not reflect physical reality, and it has not reflected physical reality for years. The only question is how long the gap between paper fiction and physical truth can persist before it closes. And every data point I track tells me the answer is not much longer. I will be back next week with updated data on every metric I discussed today. COMEX registered inventory, Shanghai premium, short position data, exchange rule changes, every indicator that tells us whether the break is approaching or receding. If something significant happens before, then I will post immediately because when this mechanism finally breaks, it will move fast. And I want everyone who follows this channel to understand what is happening in real time, rather than reading about it after the fact. Tell me in the comments what you think. Do you believe the paper mechanism can survive another 12 months given current conditions? Do you think there is a data point I am not tracking that would change this analysis? And tell me about your own experience trying to source physical silver. Are premiums rising in your area? Are dealers running low on inventory? Are delivery times extending? Your on-the-ground observations are data points that no official report captures, and they are often the earliest indicators of approaching stress in the physical market. Share what you are seeing and let us build a more complete picture together. If this analysis resonated with you, then subscribing means you will see every update as this situation develops. The mechanics I described today are accelerating, not slowing. The data is intensifying, not stabilizing. And the window to position before the break is narrowing, not widening. I do not say that to create urgency for its own sake. I say it because it is what the data tells me, and I committed to this channel that I would always tell you what the data says regardless of whether it is comfortable or uncomfortable to hear. This is not financial advice. I am not a financial advisor. I am not a licensed professional in any financial or legal capacity. I am an independent analyst sharing my personal research and analysis for educational and informational purposes only. Silver is volatile. Prices can and do decline sharply. Manipulation can continue longer than logic suggests it should. You can lose money investing in silver, whether physical or paper. Every decision you make with your money is your responsibility and yours alone. Size your positions responsibly. Diversify your risk. Never invest more than you can afford to lose. Never follow any analyst blindly, including me. Verify everything independently. Think critically about every claim, including mine. Read the source documents yourself. Form your own conclusions. And make your own decisions based on your own analysis and your own financial circumstances. Thank you for watching, and I will see you in the next one.